If I had to choose only 5 REITs to buy and hold for decades, which ones would make the list? That sounds simple, but the words buy and hold forever can be dangerous if investors misunderstand them. Forever does not mean buy once and never look again. Forever does not mean ignore the balance sheet. Forever does not mean buy any REIT just because it pays a dividend. And forever definitely does not mean paying any price for a good business. A real long-term REIT needs more than a familiar ticker. It needs strong assets, durable cash flow, sustainable dividends, scale, a manageable balance sheet, and a sector that still has a reason to exist years from now. So in this video, we are looking at 5 REITs that I would consider strong buy and hold candidates for 2026 and beyond. Not because they are risk-free, they are not, but because each one has a business model that may survive multiple cycles if the fundamentals remain strong. A forever REIT is not one you never analyze. It is one strong enough to keep earning your trust. And before we name the 5, we need to define the rules. To choose a long-term REIT, I do not start with the dividend yield. I start with the business. What kind of real estate does the company own? Are the assets essential? Is occupancy strong? Is FFO or AFFO growing? Is the payout ratio reasonable? Can the company handle its debt? Are debt maturities spread out? Does the REIT have access to capital at a reasonable cost? Are tenants diversified? And does the sector have structural demand? Those questions matter more than a headline yield, because a high dividend is only useful if the cash flow supports it. The biggest mistakes in REIT investing usually come from chasing yield, ignoring debt, buying declining sectors, or assuming a stock is safe just because it has already fallen. The best REITs are not just dividend payers. They are real estate businesses with durable cash flow. With that framework in mind, here are the 5 REITs I would put on the long-term watch list. The 5 REITs on this list are Realty Income, ticker O, Prologis, ticker PLD, Equinix, ticker EQIX, VICI, ticker VICI, and American Tower, ticker AMT. This is not a list of the highest yields. That is important. If we were only chasing yield, the list would look very different and probably much riskier. Instead, this is a list built around different engines of real estate cash flow. Realty Income gives exposure to net lease real estate and monthly income. Prologis gives exposure to industrial logistics and warehouses. Equinix gives exposure to data centers and digital infrastructure. VICI gives exposure to experiential real estate and long-term leases. And American Tower gives exposure to cell towers and mobile connectivity. The idea is not to own 5 random REITs. The idea is to own 5 different business models that may survive for a long time. This is not a list of the highest yields. It is a list of business models built to survive. Let's start with the most famous income name on the list, Realty Income. REIT number 1 is Realty Income, ticker O. Realty Income is one of the most recognizable net lease REITs in the market. Its brand is built around consistency, scale, and monthly dividends. In the first quarter of 2026, Realty Income reported 15,571 properties. Occupancy was 98.9%. AFFO per share was $1.13, and the company guided for 2026 AFFO per share of $4.41 to $4.44. That combination of scale, occupancy, and recurring cash flow is why Realty Income belongs in this conversation. The business model is simple. The company owns properties, tenants operate businesses in those properties, and many leases are structured to create predictable rental income. But Realty Income is not perfect. It can be sensitive to interest rates. Its size can make growth harder. Tenant risk still matters, and valuation still matters. Realty Income is built for consistency, not excitement. But consistency only matters if the dividend remains covered. So the next question is what investors should watch. For Realty Income, investors should watch AFFO per share growth. That is one of the key indicators of whether the business is still compounding. They should also watch the payout ratio. A monthly dividend is nice, but a covered monthly dividend is what matters.
Occupancy is another key metric. If occupancy stays high, the real estate is still being used. Investors should also watch acquisition spreads. Realty Income often grows by acquiring more properties, so the company needs to earn attractive spreads between its cost of capital and property returns. Debt also matters. If interest rates stay higher for longer, even a high-quality net lease REIT has to manage financing carefully. The big risk with Realty Income is that investors buy it only because it pays monthly dividends. That is not enough. Monthly dividends are nice. Covered monthly dividends are what matter. Now let's move from net lease income to logistics and warehouses with Prologis.
REIT number 2 is Prologis, ticker PLD. Prologis is one of the most important industrial and logistics REITs in the world. It owns the real estate behind how goods move: warehouses, distribution centers, supply chain facilities, logistics infrastructure. This matters because modern commerce depends on the movement of goods. E-commerce, retail restocking, manufacturing, inventory management, and global supply chains all need logistics real estate. In the first quarter of 2026, Prologis reported core FFO per share of $1.50. Period-end occupancy was 95.3%, and leases commenced were 66.7 million square feet. The company also guided for 2026 core FFO per share of $6.07 to $6.23. That is a strong operating profile. But Prologis is not immune to cycles. Industrial demand can slow, development can become risky, vacancy can rise, cap rates can move, and economic cycles matter. Prologis owns the real estate behind how goods move, but even a great logistics business still needs to be monitored. For Prologis, investors should watch occupancy. That tells us whether demand for logistics space remains healthy. They should also watch rent spreads. If new leases are being signed at much higher rents than old leases, that can support growth. Leasing activity matters too. A strong logistics REIT needs tenant demand. Development yields matter because Prologis can create value by building and expanding properties, but only if the economics make sense. Debt and liquidity also matter. Even a great REIT can become less attractive if funding costs rise too much. And finally, investors should watch broader industrial demand. Supply chains do not move in a straight line. E-commerce does not grow perfectly every year, and logistics cycles can become weaker when the economy slows. That is the key risk. A great logistics REIT still has to live through logistics cycles. Now let's move from physical logistics infrastructure to digital infrastructure with Equinix. REIT number 3 is Equinix, ticker EQIX. Equinix is a data center REIT, but it is more than just a landlord with buildings full of servers. It is a digital infrastructure company. Its business is tied to cloud computing, data movement, enterprise networks, interconnection, and now artificial intelligence demand. For 2026, Equinix guided for total revenue of $10.144 billion to $10.244 billion. It also guided for AFFO per share of $42.31 to $43.11. And the company said that around 60% of its largest deals in the first quarter were AI-related. That is why Equinix earns a place on this list. The long-term demand drivers are powerful: cloud, data, AI, connectivity, interconnection. But this is not a simple low-cost business. Data centers require heavy capital spending. Power availability matters, competition matters, execution matters, and valuation matters a lot. Equinix is not just a real estate story, it is digital infrastructure. But digital infrastructure can still be overpaid for.
For Equinix, investors should watch revenue growth. They should watch AFFO per share. They should watch bookings and whether demand remains strong. They should watch AI-related demand, but without blindly assuming every AI headline creates shareholder value. They should also watch capital expenditures. Data centers require large investments, so the key question is not just whether the company can grow, the key question is whether growth produces attractive returns after the investment. Power and capacity are also critical. The data center story can be limited by electricity availability, construction timelines, and infrastructure constraints. And finally, investors need valuation discipline. A great business can still be a poor investment if the price is too high. AI demand is powerful, but even powerful demand can be overpaid for. Now let's move to a very different REIT, VICI Properties. REIT number 4 is VICI Properties, ticker VICI. VICI is different from the other names on this list. It owns experiential real estate, including gaming, casino, entertainment, and leisure-related properties. The appeal is that VICI often operates with long-term leases and specialized assets. In the first quarter of 2026, VICI reported total revenues of $1.0 billion. AFFO was $650.9 million. AFFO per share was 61 cents, and AFFO per share increased from 58 cents to 61 cents year over year. That is why VICI stands out. It is a landlord to experiences, not just buildings. But the risks are real. VICI can have operator concentration risk. Gaming exposure matters. Regulation matters. Tenant strength matters. And because the assets are specialized, the quality of the operators is very important. VICI can be a strong cash flow story, but investors need to understand the tenant and sector risks behind that cash flow. VICI is a landlord to experiences, not just buildings. And before we move to the fifth REIT, this is a good moment for a quick pause. This is the kind of REIT analysis we focus on at Boring Money Wins. Not just chasing the biggest dividend yield, not just buying a ticker because it is popular, and not pretending that buy and hold means ignore the data. The goal is to understand the business model, the cash flow, the balance sheet, the dividend safety, and the long-term quality. If you like no-hype REIT analysis focused on cash flow, risk, and long-term investing, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want income investing without the noise. Now, let's look at the fifth REIT on the list, American Tower. Then we will compare all 5 side by side. REIT number 5 is American Tower, ticker AMT. American Tower is a real estate play on mobile connectivity. The company owns and operates communications infrastructure, especially cell tower assets. The long-term thesis is simple. Mobile data demand keeps growing. Networks need infrastructure, and large telecom tenants need tower space to serve customers. In the first quarter of 2026, American Tower reported AFFO per share of $2.84. Cash provided by operating activities was $1.401 billion. Free cash flow was $941 million. And the company declared a quarterly distribution of $1.79 per share. That cash flow profile is why American Tower deserves attention, but it has risks too. Interest rates matter. Debt matters. Growth can slow. Large telecom tenants matter. And international exposure can create currency risk. American Tower is a real estate play on mobile connectivity. Now that we have all 5 REITs, let's compare their roles in a portfolio. The important thing about these 5 REITs is that they do not all do the same job. Realty Income is the consistency and monthly income name. Prologis is the industrial logistics and warehouse name. Equinix is the digital infrastructure and data center name. VICI is the experiential real estate and long contract name. And American Tower is the cell tower and connectivity name. That matters because a good REIT portfolio should not just be 5 versions of the same risk. The goal is not to own 5 random REITs. The goal is to own 5 different engines of real estate cash flow. Some are more income-oriented, some have more growth exposure, some are tied to digital infrastructure, some are tied to long-term lease contracts, some are more sensitive to technology, tenants, or capital spending. So the question is not only, is this REIT good? The better question is, what job does this REIT do in the portfolio? The goal is not to own 5 random REITs. The goal is to own 5 different engines of real estate cash flow. But even with high-quality REITs, there are still risks.
Even great REITs have risks. The first risk is interest rates. If rates stay higher for longer, REIT valuations can remain under pressure and debt refinancing can become more expensive. The second risk is valuation. A great business can still be a bad investment if you pay too much. The third risk is debt and refinancing. REITs depend on capital markets, so balance sheets matter. The fourth risk is payout pressure. A dividend is only attractive if the cash flow supports it. There's also sector concentration risk, technology change risk, recession risk, tenant risk, and the simple fact that a good business can still have a falling stock price. That is why buy and hold does not mean close your eyes. It means hold while the thesis remains intact. Forever holding only works if the business keeps earning its place. Now let's finish with the final verdict.
So what are the top 5 REITs I would consider as buy and hold forever candidates for 2026? Realty Income for consistency and monthly income. Prologis for global logistics. Equinix for digital infrastructure. VICI Properties for experiential real estate and long-term contracts. And American Tower for mobile connectivity. These are strong candidates, but they are not blind buys. Price still matters, valuation still matters, debt still matters, cash flow still matters, and the business must continue earning its place in the portfolio. The best REITs to hold forever are not necessarily the ones with the biggest yield. They are the ones with the strongest reasons to still exist decades from now. And that is the real lesson. Buy and hold forever should not mean ignoring risk. It should mean owning businesses that can survive cycles, keep producing cash flow, and keep justifying investor trust. Because boring money usually wins. Because boring money usually survives.